Hey folks, I'm best-selling author of The Power Zero, David McKnight. In today's video, you'll see part one of my interview with co-founder of Power Zero, Larry DeLegge, in which we discuss the ticking time bomb in your cash value life insurance policy, whether you should put life insurance on your kids or on your parents, and whether life insurance can serve as a viable volatility shield in retirement.
The first one says, I hear you talk about IUL, but can regular dividend-paying whole life also be used to grow the cash value account? These may not have as much growth potentials, but the guarantees are good. So we get this question all the time, IUL versus whole life. Why do you prefer one over the other?
So I'm only really going to speak about which life insurance I prefer within a Power of Zero context. I'm not talking about what's the better policy overall. I'm just going to tell you what works better for the Power of Zero context. And so there's two things that I look at in a life insurance policy. Number one, if I take money out of a stock bond portfolio, I have to be able to get a productive rate of return. Whole life is going to give you a rate of return. So the question is, can index universal life give you a better return than whole life? And most actuaries I talk to say that you can get 1.5% to 2% better over time. We're talking 6 to 8% over time, gross of fees, 5 to 7% net of fees. So I think I'm going to get a better rate of return over time because I'm taking slightly more risk with the IUL because I can lose money in any given year because I can have a flat year and lose money because of those expenses. So I'm taking more risk in the IUL. My balance can go down in a given year, but I think that over time, for that risk premium, I'm going to get a better rate of return. So I don't look at it as whole life bad, IUL good. I look at it as IUL is slightly to the right of whole life on the risk continuum and slightly to the left of VUL on the risk continuum. So I want to be able to get that extra 1.5% to 2% more over time. Two, I've talked about the loan provisions before. If the whole goal in doing the IUL or any cash value life insurance policy is to build money up so that somewhere down the road you can take money out and spend it on your lifestyle, then the loan provisions become pretty darn important. And let me explain why. I started at MetLife. I went to Hancock and ultimately landed at Midland. And I had a mentor at Midland that taught me about loan provisions. He said the single most important provision and the entire contract is the loan provision. And I talk about that in Look Before You Lerp. I talk about how starting a life insurance policy is like getting married. You don't want to, these life insurance policies only really work if it's till death do you part, and you don't want to get 15 years into it and realize that you had some sort of provision in that policy that didn't ultimately help you do what you set out to do when you started the policy. And so I've got a chart. I can show it to you if you want, but the chart basically says this. If I have a net 2% loan provision, and I want to take, say $100,000 out of a policy over time per year, I am going to run out of money 18 years faster than I would a 0% loan policy. If I have just a 1% loan provision, I'm going to run out of money 11 years faster than I would if I have a 0% loan. Now, some companies start you off at a 0 and reserve the right to change it to 1, 2, or 5 at their leisure, in which case they're foxes in your chicken coop, right? You don't want to give them that much time to make up their mind over time in terms of what loan provision they're going to charge you. So the loan provision ends up being one of the very most, if the goal is to build money up and take money out, then the loan provision is going to be your very best friend. And you want that to have rock solid, ironclad guarantees. And that's why, not even all IUL companies offer guaranteed 0% loans. A lot of them offer 0% loans, but they reserve the right to change it to a higher number down the road. So I'm looking for two things. I'm looking for safe and productive growth. I'm talking between 6 and 8 net of fees, or gross, 5 to 7 net of fees over time, and I'm looking for a guaranteed 0% loan. Now, there's lots of other things I look at, but those are the two defining features that set the IUL apart from whole life. Does that mean whole life's bad? Does that mean whole life can't be used in a number of compelling contexts? No, it just means that if I'm going to use a cash value life insurance policy within a Power of Zero context, that's the policy I'm going to use. Those are the things that I'm looking for.
Here's a question about your book, The Volatility Shield. That book, can you tell us what that book was, the market for that book first? But the question is, I know that a cash value permanent life policy is the best option for this type of account that you discussed there, but if a client is older or uninsurable, what are other good options?
Okay, so let's talk about is everybody familiar with the volatility buffer concept? Okay, for those of you who are not familiar with it, let me describe it in the following way. The 4% rule says that you can only take 4% of your day one retirement balance in retirement, adjusted every year thereafter for inflation. So if you have $1 million day one of retirement, you can take out $40,000 that first year. Year two, you can take $40,000 plus 3%, so adjusted for inflation every year thereafter. So that's the 4% rule. The problem with the 4% rule is it's a pretty expensive way to go about saving for retirement. If I need $80,000 per year, adjusted every year for inflation, how much money will I need to have saved by day one of retirement? $2 million. Pretty expensive way to go about saving for retirement. So how does Dave Ramsey get around that? He says, well, you can take an 8% withdrawal rate. Therefore, if you need $80,000 per year, that first year, adjusted every year thereafter for inflation, you only have to save how much? $1 million, right? So he says, telling people $2 million stills their hope. Telling people $2 million, well, they'll never get off square one if they think they have to save $2 million. But if you can save $1 million, then that's going to get people, anything the mind can believe and conceive and believe it can achieve, right? So the question is, we know Dave Ramsey's wrong because all of the data bear that out. The question is there any reliable way to get an 8% distribution rate? Okay, and as it turns out, and there's been lots of studies on this. In fact, Ernst & Young recently came out with a study that really bears this out. So Ernst & Young basically says if you can save between 3 to 5 years worth of living expenses in a cash value life insurance policy by day one of retirement, and in the first 10 years of retirement, anytime the stock market goes down, you pay for your living expenses out of your cash value life insurance. That will give your stock market portfolio a chance to recover before you take further distributions. Now, why does the 4% rule even exist? It exists because it presupposes that in a down year, you will be taking money out of your stock market portfolio, right? That's what it presupposes. And that's why 4% is as low as that's why the 4% rule is as low as it is because it presupposes that in those 2 to 3 years of down years, in the first 10 years of retirement, you will be taking money out of your stock market portfolio, and that suppresses the amount of money that you can take out in any given year. Well, guess what? What happens to your sustainable withdrawal rate in retirement if you are not required to take money out of your stock portfolio in the year following a down year in the market? Well, guess what? According to Ernst & Young, it goes all the way up to 8%. Okay? It goes up to 8% with a 95% success rate. Okay? So here's the big irony. The only way to get the 8% rule that Dave Ramsey is so vehemently advocating for, ironically, the only way to get the 8% rule is to use a financial tool that Dave Ramsey categorically rejects, which is cash value life insurance. So the question becomes, is there any other tool out there that can allow you to get that same high distribution rate? What other financial instrument could mimic what you're trying to accomplish with the cash value life insurance? Well, here's the problem. In order to be able to do what we do with the cash value life insurance, there's a couple of different things that your financial tool has to have. Number one, it's got to be safe and productive. When I say safe, I mean you can't lose money. Because if the whole goal is to shield you from the impact of market volatility, you can't have an account that's exposed to volatility. So I was talking to somebody earlier, they said, well, why not just use bonds? Well, are bonds volatile? Dave Ramsey has long said that you should live on 100% stocks in retirement, and he's taken a lot of heat on that. And there was a recent study that sort of actually bears it out. The study basically said that bonds are much more correlated to the stock market than we previously thought, and they're much more volatile than we previously thought. So does that sound like a good volatility shield for you? Does that sound like a good volatility buffer? No, because you need your volatility shield, I call it a volatility shield. You need your volatility shield to be impervious to market loss. And if you have money in bonds and it goes down in the very year that you need to live out of that, to buy you time to let your market recover before you take further distributions, that's a problem. So there's another way you could do it. You could do it with a fixed index annuity. So some sort of fixed annuity that gives you safe and productive growth. I prefer that annuity be tax-free. So if it started off in an IRA, I would prefer to have some sort of internal Roth conversion feature so that you can systematically shift that to tax-free so that by the time you really need to draw upon it, it needs to be in place day one of retirement. Because what happens if you retired in 2000, 2001, 2002, and you didn't have that thing in place? Well, you don't have a fund to draw from to pay for your living expenses to give your stock market portfolio a chance to recover before you take further distributions. So it's got to be safe and productive, it's got to be tax-free, and it's got to be in place by day one of retirement. If you can show me something that can do all three of those things, that would serve as a viable volatility buffer.
Have you utilized the LIRP, that's a life insurance retirement plan concept, for kids as a college savings plan? Or would you recommend setting this up for young children? Also, what are your thoughts on adult children purchasing an LIRP on their aging parents? Any problems with any of those?
I don't have problems with either of those. All of my kids have LIRPs. My mom has an LIRP. I can't tell you that I'm like I bought the LIRP for my mom and I'm sitting around waiting for her to die so I can cash in, right? That's not what I do. But all of my kids have LIRPs. My wife has an LIRP. I have an LIRP. We all have LIRPs. We got a lot of money going into LIRPs every month. I'm not opposed to either of those two things. Here's what I am opposed to. I am opposed to owning a policy on my kid because maybe I'm uninsurable, and then building the cash value up on that kid, and somewhere down the road when I'm ready to retire, I strip all the money out of that thing by way of loans, and then I die, and what have I left my kid with? A completely underfunded policy that's likely to lapse. It's like, hey, yeah, let me bequeath you this underfunded IUL. Like, nice knowing you, right? So it's not a very nice present to leave your kids, right? So I don't have any problem with those other two things. The thing that I have a problem with is, hey, you're uninsurable, let's put it all on your kids and let you loan all the money out and then you die.
So what would happen if you took all the money out, you loaned all the money out, and then you passed away? What's the problem for your child?
You get a phantom tax bill. Your kids get saddled with this massive, tax bill from the IRS. So you bequeath them a massive tax bill, and by the way, they got to pay all of that all in 1 year, or they get additional penalties. So
yeah, that's an issue. All right, have you heard of Curtis Ray and his MPI solution concept?
Yeah, we were just talking about that at lunch. Yeah, Curtis Ray, nice guy. I've had conversations with him. I don't have any ill will towards him. He basically, MPIs, if you watch TikTok or Instagram Reels, he's all over the place. He's got 1 million followers. Basically what he's advocating for is a policy where and I don't profess to understand perfectly, you make a contribution to an IUL and then you turn around and take a loan out of that IUL to pay future premiums. And that triggers an arbitrage that when illustrated over time looks very, very sexy, very productive, will outperform just about any other policy or any other investment vehicle on paper. So that's the premise. That's how it works in theory. How it will play out in real life is anybody's guess. And I've told Curtis that. I said, this looks great on paper. It looks great in the spreadsheet, but a lot of these things look great on spreadsheets, right? How is it actually going to play out in real life? There's a lot of complication. There's a lot of things you got to remember. There's a lot of taking loans and paying it back. So we were just talking about that at lunch. You got to have the disposition to be able to do that type of thing. And I'm not convinced there's many of our clients and prospects that have that type of attention to detail to be able to pull that off. Yeah. Okay, folks, that was part 1 of my interview with co-founder PowerZero, Larry DeLegge. In the next 10 years, I'm looking to put 1 million Americans on the road to the 0% tax bracket. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes down the road, head on over to davidmcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the PowerZero network that's been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified PowerZero advisor, head over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.